All right, if you care about markets and you're even remotely watching metals, pause your scroll for a second. I'm serious. Something just happened in silver that almost never happens this fast. And if you blinked, you missed it. In the last couple of hours, silver blew past 120 in Western markets while China quietly priced it, like it's already living in the future. Shanghai spot is carrying an $18 premium. Futures are trading at 146. And that gap right there, that's the story. I'm not talking about a small divergence. I'm talking about a $26 spread between what paper says silver's worth and what actual buyers are paying to get physical metal delivered right now. Stay with me because I'm going to show you why this isn't just a price spike, why it matters to you right now, and how to recognize this kind of setup before it shows up on everyone's radar. Before I explain what caused this, let me teach you something most people never really internalize. There isn't one silver price. There's a paper reference price that everyone watches on their screens. And then there's the price real buyers are actually paying when metal has to move, clear customs, and show up on a balance sheet. Think of it like airfare. The advertised ticket looks cheap until the last seats disappear, and suddenly the real price tells the truth. When premiums explode, the market is screaming that supply isn't keeping up with reality. And when those premiums stay elevated across regions, that's not noise. That's a signal. So, what does that tell us? It tells us the infrastructure holding the paper price together is under stress. It tells us that somewhere in the system, there's not enough metal to satisfy everyone who thinks they can get it at the quoted price. And here's what's critical. When you see this kind of premium structure emerge across multiple markets at once, you're not looking at speculation. You're looking at mechanics. Now, let me show you what's actually happening, because the sequence matters. Physical silver inventories have been draining for years, not months, years. Solar demand keeps pulling metal out of circulation at an accelerating rate. Tech demand isn't slowing down, and investment demand just hit the accelerator in the last quarter. At the same time, major refiners like Perth Mint and Metalor have either paused or severely limited new orders. That's not a headline gimmick. That's a supply choke point. When refiners step back, the pipeline freezes, and premiums don't rise gradually. They gap. They jump in a matter of hours because suddenly the market realizes there's a finite amount of deliverable metal available right now, and the people who need it are willing to pay more to get it first. So when China steps in and says, fine, we'll pay more, that changes everything. Shanghai buyers aren't bidding for paper promises. They're bidding for immediate delivery, actual bars that can be weighed and stored. And futures on the Shanghai Futures Exchange are reflecting that urgency. Western markets, meanwhile, are still anchored to paper contracts that assume smooth delivery, that assume the metal's there when you need it. That's how you end up with this $26 premium between regions. And here's what's wild about this. That spread isn't speculative. It's not traders guessing about the future. It's mechanical. It's buyers competing in real time for what's actually left in the available pool. Now, let me layer in what's confirming this isn't just a China story. COMEX inventories have been bleeding out steadily. We're not talking about a one-week blip. We're talking about a months-long drawdown where registered silver, the metal that's actually available for delivery, has dropped to levels we haven't seen in years. When you cross-reference that with what's happening in London vaults, you see the same pattern. Metal is leaving, it's going to buyers who want possession, not exposure. And when vault withdrawals accelerate while prices are rising, that tells you something really important. Higher prices aren't bringing more supply to market. They're revealing how tight supply already is. But here's the part that should make you nervous. When physical and paper markets decouple like this, the paper price stops being a reliable signal. Margin requirements can change overnight. Exchanges can step in and alter contract specifications. Liquidity can vanish when you need it most. And if you're only watching the headline spot price, you're flying blind while the real stress shows up in delivery volumes and vault withdrawals. That's the canary in the coal mine. And right now, that canary isn't chirping, it's screaming. The futures curve has flipped into backwardation, which means near-term contracts are trading at a premium to future contracts. In normal markets, that doesn't happen. In normal markets, future delivery costs more because of carrying costs, storage, insurance. When backwardation shows up, it means the market is paying a premium for metal today because there's uncertainty about whether you'll be able to get it tomorrow. Zoom out for a second, because this isn't uncharted territory. This is the exact same playbook we saw during the 1980 silver spike, when physical demand overwhelmed the structure holding paper prices in place. Back then, the Hunt brothers weren't the whole story. The whole story was that industrial and investment demand had created a structural deficit, and when the scramble for physical metal began, paper prices had no choice but to follow. What happened next? Silver went from $6 to $50 in less than 18 months. Now, I'm not predicting that exact move, but I am showing you that the pattern rhymes. Let's go back further. In 2011, when silver ran from $18 to nearly $50, what preceded that move? Rising premiums, delivery delays. Refiners couldn't keep up. Mints were rationing, and by the time retail piled in, the move was already well underway. The explosive phase didn't start with headlines. It started with premiums, backwardation, and delivery stress. Same pattern we're seeing today. Every time silver has entered a sustained deficit cycle, not a one-off squeeze, but a structural shortage, prices didn't just move up, they repriced. The market had to find a new equilibrium where supply and demand could actually meet, and that equilibrium was always higher than where paper contracts suggested it should be. And then there's 2020. Remember March 2020 when silver crashed to $12 and premiums on physical coins and bars went to $8, $10, $12 over spot? That wasn't manipulation. That was the market screaming that paper prices had completely disconnected from physical reality. If you wanted actual metal, you couldn't get it at $12. You had to pay 20 plus. And within 6 months, spot had doubled. The larger story is this. Whenever the physical market leads, the paper market eventually has to catch up or break. We've seen this movie before. Now let me be skeptical for a moment because you should be. Could this cool off? Absolutely. Markets don't move in straight lines. Exchanges can raise margins, which forces leveraged players to liquidate positions. Governments can intervene. China could step back. Traders can get shaken out on volatility. And yes, silver has a long history of brutal volatility. It can drop 15% in a day and shake out everyone who thought they were riding a rocket ship. But here's the thing. You don't need to predict the exact top or bottom to read the structure. Focus on what you can actually observe. Premiums, inventories, delivery demand, backwardation. Those don't lie the way sentiment does. They're mechanical indicators of supply and demand balance, and right now they're all flashing the same signal. There are probably 3 types of people watching this right now. The first is the long-term holder who's been early and patient, who's been stacking for years and suddenly feels vindicated. If that's you, this isn't about victory laps. It's about risk management and understanding how quickly conditions can change. You've seen silver run before. You've seen it crash before. Your edge is staying disciplined when everyone else is getting emotional. Watch your position size. Think about where you take some risk off the table. And remember that being right early means nothing if you give it all back when volatility hits. Your job is to protect what you've built while the opportunity window is open. The second is the trader who feels like they already missed it, who's watching the chart go vertical and thinking, I should have bought at 90, I should have bought at 100. Let me be honest with you, chasing vertical moves is how accounts get wrecked. This is the point where discipline matters most. If you're not in, your edge isn't trying to catch the rocket mid-flight. Your edge is waiting for confirmation, for a pullback, for structure to form that gives you a decent risk-reward setup. Yeah, you might miss some upside, but you'll also avoid blowing up your account on a 30% drawdown that happens in 3 days. The market will give you another entry if this is real. Be patient. Let it prove itself to you. And the third is the skeptic, who thinks this smells like manipulation or hype, who's seen silver pumps before and got burned. That skepticism is healthy. Honestly, it's necessary. Just make sure you're skeptical of dismissing real data, too. If your skepticism is based on emotion or past losses, that's not analysis, that's trauma. Look at the premiums, look at the inventories, look at the backwardation. If you can explain those away as noise or conspiracy, fine. But if you can't, maybe there's something here worth paying attention to. The universal principle for all of you is the same. Structure beats narrative, always. I don't care what the story is, I care what the data shows. So here's where I stand. I'm not euphoric, and I'm definitely not complacent. I'm watching 3 things very closely. First, I'm watching whether Shanghai premiums stay elevated or accelerate. If that premium widens past $20 and holds there for days, not hours, that tells me Chinese buyers see something structural, not tactical. Second, I'm watching whether Western vault inventories keep draining despite higher prices. If COMEX registered silver keeps falling while prices are above 120, that's confirmation that supply isn't responding the way it should. And third, I'm monitoring whether futures curves stay in backwardation, signaling immediate scarcity. If backwardation deepens or spreads across more contract months, that tells me the market's not expecting this pressure to ease anytime soon. Based on my analysis, this move wasn't random. It wasn't emotional. It was mechanical. Physical buyers stepped up. Supply couldn't meet that demand at prevailing prices, and premiums gapped to clear the market. That's not a narrative. That's how markets work when supply and demand get out of balance. The fundamental picture hasn't changed from yesterday, but the urgency has. What was a slow bleed in inventories just became a sprint. What was theoretical tightness just became actual delivery stress. And when paper and physical diverge by this much, history says the paper price eventually has to catch up. Now, I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. But if history rhymes and physical demand continues to overwhelm the paper structure, the move that follows could make this spike look like the warm-up act. We've seen it before. The pattern's there. The question is whether you're positioned to respond to it or whether you're still trying to figure out what's happening while it unfolds. If you made it this far, you're thinking ahead. You're asking the right questions. That mentality will serve you well whether silver's your play or not, because markets are always teaching lessons to people who pay attention. If this analysis helped you see something you weren't seeing before, share it. Hit subscribe if you want more breakdowns like this where we skip the hype and focus on structure. And drop a comment telling me what you're watching right now. Are you in? Are you waiting? Are you skeptical? I want to hear your perspective. Stay sharp out there, verify what you see, and make sure you understand the game you're playing before the rules change again.